Welcome to the Deep Dive. Today, we're taking a closer look at Gecina's recent earnings call.
Right. They're active in business and residential real estate, so always interesting to see their take.
Definitely. Our mission, as always, is to unpack the key info, get management's view, and, figure out what it all means for the market right now.
Okay, let's kick off with the headline numbers. Gross rental income was up 3.6% on a current basis.
3.6%. Solid. What drove that?
Well, it was mostly their existing properties performing well. That's the like-for-like, and also newly delivered assets coming online.
Okay, so new buildings helping out.
Yeah, and that growth actually offset the impact from assets still in the pipeline and, the ones they sold off.
Makes sense. So let's dig into that like-for-like growth. You said that was a key driver.
It was. Like-for-like rental growth hit 3.3%.
And how did they get that 3.3%?
Mostly through indexation, so rents adjusting upwards. That added about 4.2%, actually.
Wow, indexation alone was higher than the total like-for-like.
Well, yeah, but then you also had reversion playing a part on certain properties.
Reversion meaning when old leases end, they sign new ones at current market rates.
Exactly. Capturing that uplift, especially in desirable spots, plus their service offerings factor in too.
Got it. And leasing, how active were they?
Really strong, actually, across all geographies. Management talked about dual polarization trends.
Dual polarization?
Yes.
Sounds like the market's splitting.
Kind of. It means the really top quality assets in the best locations are in high demand, and Gecina seems to be benefiting.
Any numbers to back that up?
Oh, yeah. In just the first 3 months, they relet or renewed 41,000 square meters.
41,000, okay.
Across 33 deals. And that generated almost $19 million in annualized rent.
19 million annualized, just in Q1.
Yep. And get this, that's already half the total leasing they did in all of 2024.
Half the year's leasing in one quarter? That is strong.
Tells you something about demand, right? Yeah. And the rental uplift overall was plus 9%.
9% increase on those new leases. Not bad.
But it gets better. In Paris City, it was 17%.
17, okay.
And in the Paris CBD, the central business district, a huge 27% uplift.
27%. That really shows that polarization you mentioned.
Yeah.
Prime spots commanding big premiums.
Exactly. And they also mentioned residential leasing picked up pace too.
Good to hear the residential side is accelerating as well. What about occupancy overall? Are the buildings full?
They expect occupancy to gradually improve through the rest of 2025.
Okay, a gradual climb. Any news on their development projects?
Yes, the Icon Pipeline project, delivered in Q1, on schedule, within budget.
Good execution there.
And the student housing disposal that's still on track to close in the first half of this year.
So selling off those student assets as planned.
Correct. And importantly, they confirmed their full year guidance for 2025.
Guidance confirmed. Okay, that covers the snapshot. Let's get into some specifics now.
Sure.
We talked about the strong leasing, especially in Paris. But what about areas outside those prime spots, like Buello?
Right. Buello and other, let's say, non-central locations, they acknowledge leasing there is, well, more challenging.
That fits the polarization idea.
It does. But they did highlight some wins. Deals signed in Orison with media firms and Surresiness with an FMCG company. Over 5,000 square meters combined.
So progress is being made, just maybe requires more effort.
Yeah, that's the sense. They said it's progressing, according to their plans.
Okay. Shifting gears, the investment market. Are people buying buildings like Gecina's?
Their take is, yes, there's still decent activity, especially for central locations. Think smaller, well-located, well-designed assets.
So smaller deals in prime spots are moving?
Seems like it. They said the market feels more fluid than maybe last year, but less liquid for properties outside Paris or for really big schemes.
And Gecina's position, buying or selling?
They're watching both sides, basically, actively monitoring opportunities to buy and sell opportunistically.
Okay. Now, there was a point about like-for-like growth in those other locations dropping by 25%. That sounds pretty steep.
It does sound steep, you're right. But context is key here.
What's the context?
It's a relatively small part of their whole portfolio. And the drop was mainly due to specific tenant departures.
Specific buildings.
Yeah, they mentioned Mougins, where Orange left, though they've apparently relet that space already.
Okay, so already filled.
And also Field in Poutot, where about half the building became vacant after a departure. But again, they're actively working on releasing that space.
So localized issues they're addressing, not a portfolio-wide trend in those areas.
That seems to be the message, yes.
Understood. Someone asked about buying the Solstice building. Any news?
Yeah. Standard procedure there. Management policy is not to comment on potential deals before they happen.
Right. Keep it confidential until it's done.
Exactly. They just reiterated they're always looking at the market, buying and selling, like they've done for the past decade.
Fair enough. Let's talk indexation. Inflation's been easing a bit. How does that affect their rent increases going forward?
They expect indexation to slow down. The construction cost index and GDP growth forecasts are pointing that way.
So smaller automatic rent bumps from inflation.
Probably. They're thinking it will land around 2%, maybe even a bit lower, progressively.
2%, down from the 4.2% boost we saw recently.
Yeah, quite a change. But they also noted there's a lag effect. Inflation takes like 12 to 18 months to fully filter through to the P&L and cash flow.
So they still have some visibility from past inflation baked in.
Exactly. Gives them some near-term predictability. And, lower inflation might mean lower interest rates eventually.
True. A move towards a more normalized environment, perhaps?
That's the hope, I think.
What about selling assets? Besides the steel and housing, are they planning more disposals this year?
No specific target set, apparently. It's more opportunistic.
Opportunistic how?
If they get a good offer or if the market shows strong appetite for a certain type of asset they hold, they'll consider selling. But no forced sales target.
Got it. Flexible approach. And their debt. How's the balance sheet looking? Leverage.
They stress they manage it conservatively. They watch net debt to EBITDA, of course.
Right.
But they pointed out that rating agencies focus more on loan to value, the LTV.
Why LTV?
Because their assets are seen as highly liquid, prime real estate. So LTV gives a better picture of risk in the agency's view.
And is the LTV okay? Are debt levels manageable?
They highlighted a trend of NAV net asset value growing, while debt has actually been reducing recently. So the balance sheet seems to be strengthening.
Okay, good trend.
Right.
One last area, Paris CBD. There have been some worries about rising vacancy there. Did they address that?
They did. They acknowledged vacancy has increased in the CBD. No denying that.
There's always a but.
But their view is it's still below historical averages for Paris CBDs. And crucially, they are still seeing strong leasing demand and significant reversion potential.
So their own properties in the CBD are still performing well despite the broader vacancy stat.
Yeah. They even noted occupancy grew in their specific Paris portfolio during the quarter. So their assets seem resilient.
Interesting contrast.
Though they did concede, the macro picture, geopolitical stuff. That obviously influences overall leasing decisions.
Sure. External factors always play a role. Okay, that's a pretty thorough deep dive into the call itself.
Covered a lot of ground.
Indeed. Now, for our favorite segment. This is not financial advice. Time for some outrageous but plausible trade ideas based on all this.
All right, let's brainstorm. Idea number one, thinking about that huge 27% rental uplift in Paris CBD.
Yeah, that number really stood out, especially with the vacancy concerns floating around.
Exactly. So the outrageous but plausible idea, maybe look at going long on companies heavily weighted towards prime grade A commercial property, specifically in Paris CBD.
Okay, the outrageous part is betting against that negative CBD sentiment.
Precisely. Swimming against the tide a bit. But the plausible part comes directly from Gecima's numbers. They're seeing the demand, they're getting the rents in that specific segment.
So using the results as evidence that the premium end of the CBD market is perhaps stronger than the overall stats suggest.
You got it. A targeted bet.
Interesting. Okay, what's idea number two?
Second one focuses on their stability. They confirmed guidance. The student housing disposal is on track. Suggests good execution.
Right, sticking to the plan.
So how about a pairs trade? Go long Gecina or a similar firm showing that kind of stability and execution.
Okay, long Gecina or a lookalike.
And short, a sector that's facing more obvious headwinds right now, something with more uncertainty baked in due to the economy.
Ah, the classic pairs trade. Contrasting stability with instability. What's the outrageous bit there?
Just the direct contrast, maybe, pitting Gecima's perceived stability against a sector actively struggling.
And the plausible side.
It's grounded in the positive specifics from this earnings call, the confirmed guidance, the disposal progress. It suggests Gecima might be relatively well-positioned compared to others.
Two interesting angles there. A targeted location bet and a stability pairs trade.
Just ideas to mull over, of course.
Absolutely. And that brings us to the end of our deep dive on Gecima's latest call. We've unpacked the results, the trends, management's view,
and thrown out a couple of wild ideas.
based purely on the information discussed, naturally. Remember, everyone, this is purely for informational purposes. It is definitely not financial advice.
Please do your own research before making any investment decisions. Thorough research.
Couldn't agree more. So what were your key takeaways from this? Anything jump out at you? Let us know.
Yeah, join the conversation.
Thanks for joining us on The Deep Dive.